Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Milind, Mehere, CEO and co-founder of Yieldstreet, to discuss why investors are turning to private market investments and what the top trends are for 2023. Milind, it's great to have you with us. Welcome to Trade Talks.
Thank you for having me.
You got it. Despite the volatility in 2022 and the uncertainty in the market outlook for 2023, many investors saw the benefits of private markets. What was so attractive about them?
So Jill, as you know, 2022 marked one of the most volatile and worst performing years for public markets, with all the major indices down. And this was really fueled by investors' fears of the upcoming recession and stalling of growth. It was driven by, as you know, high interest rates, high inflation, and then geopolitical tensions. And historically, when equities sell off, we know that bonds really do well. But this time around, bonds have not been doing well because of, again, the rising interest rate environment. So where does an investor turn to in this type of a situation? That's really where private markets come in. I think historically, fixed income has provided a safe haven. And I think the benefits of private markets are shining through last year. And the idea really is that diversification, drawdown protection, and structure is going to really help investor enhance yield in their portfolios if they have exposure to private markets. And so that is the reason why private markets are very attractive at this time.
There are 5 areas in the private markets that Yieldstreet has identified as top opportunities. We'll go through each one here. Let's talk about real estate. Why is that attractive and what's the approach to it?
Yeah, absolutely. So real estate, obviously, as we all know, is one of the biggest asset classes. It has historically been a source of attractive returns for many decades. It came under pressure in 2022 because of high interest rate, which led to a lot of capital market volatility, slowdown in transaction volumes, and tighter credit. But on the flip side, investors are sitting on billions of dollars of capital earmarked for real estate. If you think about real estate, because of high interest rate, there is slowdown in buying activity. But on the flip side, single family rentals, multifamilies are still doing exceedingly well because the rental market is still continuing to be strong. And for some of us in New York City, we are seeing the pains of it even now. And so I think despite near-term headwinds, we believe real estate has the long-term ability to serve as a foundation for private markets. And I think in 2022 also, we saw 5.5% returns for private real estate versus, almost 25% decline for public REITs. So that's why I think real estate is really something that we should watch out for in the next 12 to 24 months.
What about private credit?
Oh boy, I think private credit is a very, very interesting asset class. I mean, if you look at KKR came out with this report about a month ago, that how there is this regime change and what's the real influence of private credit. And I think one of the things that is very attractive for private credit right now is that given all the regulatory changes, banks are really tightening how they lend. And that's really where private credit can come into picture. And now, given the high interest rate, you can actually structure deals that are floating rate deals. And because of that, you can really have great structure. Because it's floating rate, you are protecting against inflation. And at the same time, because the borrowers are keen to do business with you, there is a tremendous opportunity for you to make money in private credit. So I think, we are really believe in the ever expanding role of private credit. And I think as we go into this volatile period, are we going to get into a recession? How deep is it going to be? That is going to land us into increased delinquencies in the consumer portfolio. And again, I think that's really where we get back to triangulating on private credit and why that's going to be very attractive for us in the coming year.
Now, what's the approach when it comes to art?
Yeah, so art, as we know, is almost a $2 trillion asset class. And historically, it has been only accessible to the super wealthy and the institutions. And if you look at 2022, despite of high inflation, art market had the biggest year of their life. Sotheby's, Christie's, and Phillips, 3 of the biggest auction houses, had the biggest sales. You look at Paul Allen's private collection, then went on sale, generated 1.6 billion. So art can be, almost equated to real estate, where blue chip art has historically beaten the S&P 500 over the last 15, 20 years. And so if you really focus on blue chip art and have a longer term view, art is a great asset class to be in. And I think one of the things that people don't realize is that, yes, while art prices are rising, why are they rising? Up until now, only highly developed Western economies could participate in art. And within that, as I said, only high net worth and ultra high net worth. What is now happening is that art is getting democratized. And there are tremendous level of buyers in Asia, LATAM, that are actually entering the market for the first time. So it is not a coincidence that the art values are going up. It is because there's a completely different buyer pool that the world of art is tapping into. And so we feel that as long as you know that you're in blue chip art, you are always going to, you're always going to do well if you have a longer term view.
Explain to us what legal finance is and what kind of approach would you take with that?
Yeah, absolutely. So legal finance has recently boomed, as law firms and plaintiffs and investors realize the benefit of specialized lending strategies in legal. So the investment class is actually pretty simple. It focuses on financing lawsuits in exchange for the proceeds that you get from settlements. And in today's market volatility, legal finance stands to truly stand out because it is truly non-correlated to the market. So if you are, for example, suing, the opioid crisis, right? There's going to be a settlement that's going to happen, but you need money to be able to process all of those law cases and trials and stuff like that. The same goes for NFL concussion cases or the 9/11 aftermath of 9/11. And so obviously the legal process takes time, but you need money in order to finance all of those trials and all of the things that go with it. And so historically, hedge funds have been entering that. And, because it's non-correlated to the stock market, doesn't matter what happens. It's really, reliant on the legal system. But then ultimately, when you win a judgment, you're going to get paid against your investment. And I think so that's the reason why legal finance has really become popular in the last 10 years or so. And now it's venturing out from hedge funds to even banks financing, senior secured financing against the legal asset class.
Interesting. Let's talk about the fifth pillar here, private equity and venture capital. I want to ask you about that approach, but of course, we need to discuss what's happening with Silicon Valley Bank. Does that alter the thesis at all?
Yeah, listen, I think it is very unfortunate, just to comment on Silicon Valley Bank's situation. As we all know, Silicon Valley Bank has been a pillar of innovation for last 40 years and really fueling technology innovation. So I think all of us should do our part to support it. I frankly do not know the details at all. I have only looked at it from a very cursory standpoint. So I do not know the underlying risk that the bank had or anything to do with that. But in general, I think obviously I feel that if something were to happen there, it would have a tremendous repercussions for the innovation industry. But having said that, I think private equity and venture capital is an extremely interesting asset class. As we all know, starting from COVID, there was unprecedented investment, financing, and fundraising activities seen in PE and venture capital. And what that has happened is that it created a completely new investment paradigm. You couple that with SPACs, money was just awash. And then we've been speaking about what has happened in 2022 to the markets. And what has that created is a real gap where on one side, people are sitting on dry powder, but valuations have reset. And so, as we all know, some of the best vintages that private equity has had over the last 20 years is coming out of a big crisis. So after GFN, there was a period of low inflation, but also low growth. But those vintages did really well as we came out of that and went into a period of high growth, which was from 2016 to 2019 or so. And then we entered the period of high growth, high volatility, which is from 2020 to now, right? And so I think the vintages that are going to come out of VC and PE are going to be the one to watch out for if you look at the next 5 to 7 year period that you have. But I think you have to be careful. I think you might not want to jump in very quickly. You might want to have a wait and watch scenario when it comes to PE and VC, because I feel that you still have 2-3 quarters for you to wait and see what ultimately happens with the recession, what happens to the growth numbers. Are the growth numbers sustainable for big companies? Because that's going to drive some of the investment thesis for private equity starting in 24, going up all the way to the end of the decade.
And finally, Milind, what type of investor or private market alts appropriate for, and how do they fit in one's portfolio?
Excellent question. So what we like to say is that the traditional 60-40 portfolio is dead. Why is that? Because historically, and we've been hearing about this for over the last 24 months, it's not been performing really well. If you think institutions, they have already moved away from 60-40 in the last 2 decades. They're probably somewhere in the 40-30-30 range, where the last 30 is private equity and private markets. And if you think what the proof point for that is, look at the growth of Blackstone, Apollo, Carlyle. Coming out of the global financial crisis, Blackstone was a $40 billion AUM manager. It's now crossed $1 trillion. Why? Because scalpers, endowments, foundations have all given them money because they've been performing really well. If you think about even what they did outside of institutional money is with BREIT, right? They scaled BREIT, the Blackstone real estate REIT, to over $60 billion. So when smartest investors in the world, like the institutional investors, are allocating to private markets, we feel that consumers and retail investors should also allocate to private market. Who are these retail investors? It really depends. If you are an accredited investor, you should have exposure to real estate, private credit, infrastructure, maybe private equity a little bit. But if you're a wealthy individual or a high net worth, you might want to change that mix a little bit. But we feel that time has come for us to take advantage of some of the regulatory changes that have been happening and really exposing oneself to private markets. So I think that's really, for me, what I'm saying is that 40-30-30 is the new portfolio construction, and you should diversify your portfolio because private markets have historically shown that if they are in the mix, they are outperforming both in terms of the cash that you have as well as the portfolio performance of any portfolio.
All right, Milind, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.